Hello. In this video, we'll talk about the discontinued operations section of the income statement. What is a discontinued operation? It's when a company decides to sell or dispose of a component of their business profits, a component of their business, the profits from the discontinued operations will not continue. So a discontinued operation can be when a company sells or disposes of a component of an entity, and that could be anywhere from a subsidiary. They get rid of an entire subsidiary. They get rid of an entire segment of business. For instance, I used to work for a pharmaceutical company, and they got rid of, I can't remember which one it was, but let's just call it their skincare line. But they had an eye care line, they had made eye care products, and they made neurology products, pharma products, and they had skincare. So if they decide to get rid of their entire skincare line, that would be considered a discontinued operation. If they were to decide to stop making one or two products within their skincare line, that is not a discontinued operation. That's normal day-to-day business. A disposal has to represent a strategic shift, and it has to have a major effect on the company's operations and financial results. This could be also if you decide to close down some of your operations in certain countries. That's a strategic shift, right? And that's going to have a major effect on your operations. The discontinued operations, the gain and loss or income and expense from it, are reported on the income statement. However, on the income statement, if you recall, begins with your revenue and expenses from continuing operations. And at the end of it, you get your income from continuing operations before taxes. Then you have your income tax expense to get your income from continuing operations. When you have discontinued operations, you report it separately right underneath. In this example, income from discontinued operations is $200 net of $50 tax expense. And so therefore your total net income is $900. We separate the discontinued operations from continuing operations because as a user of the financial statement, they would want to know if a user of the financial statement wants to know what is going to be your continuing business. If I'm going to invest or loan you money, right, or buy stock in your company, I want to know what is going to continue in the business in the following year and the following years. So that's why we separate it, because it's more representative of what the company will be like in the future. Also, when a company has a discontinued operation, when they report their financials, when they report their income statement, they report the current year and the prior year to that, they report 3 years worth. So if you discontinue your operation in the current year, we're going to call it that year one, companies have to restate the prior years that are shown on the financial statements in order for investors to be making apples to apples comparison. So they have to strip out from their continuing operations the discontinued operations component in the prior years, even though that's not how it was reported in the prior year. When a company decides to sell or dispose of a part of its operations, that doesn't happen overnight. It happens over a long period of time. And when you think about your accounting period, and let's call my accounting period an annual period that starts at 1/1/X1 and ends at 12/31, right? Let's just say I could decide to dispose of my skincare line, in my example, on February 2nd. That's a non-event. And I don't actually get to dispose of it. I don't get rid of it until 10/1, right? So you can get rid of a operation, selling or disposing of it within the reporting period. And if that happens, right, when the discontinued component is sold before the end of the reporting period, here's how you report your income from the discontinued operation part. You take your income or loss from operations of the component. I'm going to call it the discontinued component from the beginning of the report period to the disposal date. So if in my example, if I get rid of my skincare line on 10/1, I would look at the income and loss, the net income from the skincare line between January 1 and January 10th, and report that all as a discontinued operations on my income statement. And then I would also, plus, you have to report the income or loss, plus the gain or loss on the disposal of the company's assets. So you have two things you must disclose if the component has been sold within the reporting period. And let's go into an example to show what happens. In October 2027, management of Duluth Holding Company decided to sell one of its divisions that qualifies as a separate component according to GAAP. On December 18th, the division was sold. Consider the following facts related to the division. So when we're talking about here, we're talking about the division that was discontinued. From January 1 through the disposal, which was December 18th, so from 1/1 to 12/18, the division had a pre-tax loss of $5 million. Okay, and then the assets of the division had a net selling price of $15 million and a book value of $12 million. So we sold it for $15 million, where the value was $12 million. So we had a profit, or let's just call it, we had a gain on the sale for $3 million. It continues to tell us Duluth income statement for 2027, beginning with after-tax income from continuing operations of $20 million would be reported as follows. So this is showing you the income statement, right? But all above it was the revenue expenses from continuing operations, and it says our income from continuing operations is $20 million. Our tax rate, the 20 million is after tax income. So we had a before income from continuing operations before tax, we had income tax expense, and we got to the net of 20 million. That's all from continuing operations. Then we report the discontinued operations. And we report it as, we say, loss from operations of discontinued component, including a gain on the disposal of $3 million. So we report it in this, we report it as one line item. You can report it as two, but this is the $5 million loss from right here, plus you can't really see it, the $3 million gain. Oops. The $3 million gain from the 15 minus 12 plus 3 million, right, gives us a net $2 million loss from the operations. It says including gain on disposal. So if you're going to report it all on one line, you have to either in parentheses say that what the gain on the disposal was, or in a disclosure note. Either way, somehow the reader has to know what the gain on disposal was, or loss, if that's the case. Well, now we have a net loss of $2 million, and the tax rate is 25%, which is $500,000. And we have what's called income tax benefit. So usually, up until now, we've seen income tax expense. We usually have income, and then we have, 25% of income tax rate, and we reduce our income before tax by the tax expense. This is a benefit because now we have a loss. So now we're going to pay less in taxes because we get to utilize that loss. We get to offset our 20 million by that 2 million. So instead of paying tax on 20 million, we're going to actually pay tax on 18 million. So that's why this is an income tax benefit. And You have your loss on discontinued operations, which is 1.5, which is a $2 million loss, plus a $500,000 benefit to get you to a net income of $18,500. So now let's talk about when a component of your company has been sold or disposed of, and it's not within one reporting period. So if I have a reporting period here and I have 1/1x1, and I decide here on April 1, I decide I'm going to sell, this segment is going to be for sale. My skincare line is going to be for sale, right? And I have to report on 12/31, but 12/31x1, but my sale does not actually happen till February of 2000x2. So it doesn't happen till the end of the following year, past my reporting period. When that is the case, you have to report also the income or loss from the operations of the component from the beginning of the reporting period to the end of the reporting period, plus the impairment loss, which is if, so it's not always a given, if the fair value of assets of component minus the cost to sell is less than the book value. So let's just write that out. So the fair market value of the assets minus the cost to sell is less than the book value, right? It means basically we think what we're going to end up getting for the segment or whatever part of the operations we're selling or disposing of, whatever we're going to get is going to be less than the book value. Then we have to report what's called an impairment loss. Just want to come back to this part where we have to disclose the income or loss from operations from the component from the beginning of the reporting period to the ending of the reporting period. Even though we decided to sell, let's just say our skincare line on April 1, and it didn't sell until February of the next year, that doesn't matter what, for reporting purposes, you're going to look at your skincare line, right? And look at the income, the net income from the skincare line from January 1 to 12/31, and that's what you're going to report on your income statement as a part of discontinued operations. Let's take this example. October 2027, management of Duluth Holding Company decided to sell one of its divisions that qualifies as a separate component according to GAAP. On December 31, the end of the company's fiscal year, the division had not yet been sold. And considering the following facts. For the year, so we're talking about the entire year from January 1 to 12/31, the division reported a pre-tax loss of operations of $5 million. And on December 31, the assets of the division had a fair value minus anticipated cost to sell of $9 million, and the book value of the assets was $12 million. So let's just take this number 2 for a second and back to that drawing that I did. If you have fair market value, right, of your discontinued assets, less cost to sell is less than the book value, then you're going to report an impairment loss. So in our situation, the assets of the division had a fair value minus anticipated cost of $9 million, and the book value was $12 million. So the $9 million is less than $12 million. So we're going to have a $3 million impairment loss to report for this for the 2027 reporting year. I quickly erased that, but I just want you to see how it was calculated. So first we're going to report on the income statement. The income from continuing operations was $20 million, which they tell us is the after-tax income. So the same as the prior example. And then we're going to report our discontinued operations. And the loss from the discontinued component, including the impairment loss of 3 million. So it had told us in number 1 here that the division reported a pre-tax loss of $5 million. And then we had our $3 million impairment, and that's how we get to the $8 million. Again, it tells you here that including impairment loss of 3 million. You can do it in 2 different lines. You can, on the face of the financial statement, you can do it in these parentheses, or you can disclose it. And because this is a loss, again, we have to show an income tax benefit at 25% is $2 million. And we have our loss on discontinued operations of $6 million. Our net income is $14 million. Additionally, when you decide to discontinue a portion of your operations, you also have to reflect the assets and liabilities related to those operations separately on your financial statements. This is an example of Campbell's Soup Company. They disposed a portion of their company, of their operations in 2019, and they had to report all the assets and all the liabilities associated with that operation.